that in a real gold bull market, silver outperforms. And up until this year, it was underperforming. That's why earlier in the year, you could buy 100 ounces of silver for 1 ounce of gold. Now, I didn't check the ratio, but I think it's around maybe 67 or something. It's below 70 to 1. Still cheap. Silver is still cheap, but it's not nearly as cheap as it was.
It's an interesting situation. Silver has been suppressed by China in terms of price for years. The Silver Institute reckons that it's been in supply deficit for the last 5 or 6 years. And the only thing that makes up the difference is something called investment. So you've got investors, if you like, supplying the silver. Now, within that investment total, I don't think there's an awful lot in terms of genuine investment, but what there is stockpiles. And this particularly includes China. And what China has been doing is that when there is industrial demand around the world,
I expect silver to be back up at the high from today, maybe by Monday. And gold, before gold sold off, gold was up about $70 at the highs today. And it still closed up over $20, even though silver was down, $1.60, right? Gold held strong on the day, even with this profit taking. But gold got less than $30 away from hitting a new all-time record high. Now, if you recall, on the last Schiff Gold Market Wrap that I recorded, I specifically said that silver was going to hit a new record high before gold. That prediction came true. I also said that gold and silver stocks, the GDX and the GDXJ, which were way off their highs, I said that they were going to hit new record highs or new highs for the year before gold hit a new high. And that prediction came true this week. We had a big move up in the GDX and the GDXJ, both indexes hitting new highs. This is another great sign because in the prior leg of the gold bull market, gold was going up, but you weren't seeing confirmation in silver. You weren't seeing confirmation in the mining stocks. Now we're seeing confirmation by both. Instead of gold leading silver and the mining stocks, it's following. Silver has now taken over the baton from gold. Silver is leading the charge higher. Yes, it's doing it with more volatility, but it is leading. And the gold mining stocks are now leading the metal. You see, in the earlier stages, a lot of people were looking at the gold rally with a lot of skepticism because they weren't seeing the confirmation in the silver market, and they weren't seeing the confirmation in the mining stocks because mining stocks investors didn't have confidence in the gold rally. They expected gold to collapse, and so they didn't want to pay up for earnings that may never materialize. And so there was a lot of hesitancy to buy the gold mining stocks.
Earlier in the year, skepticism surrounded gold's rally because confirmation was missing. Silver lagged. Mining stocks stalled. That dynamic has now decisively reversed. Silver reached new highs ahead of gold, while gold and silver miners, represented by major mining indexes, broke to new yearly highs first. This shift matters enormously. In a healthy precious metals bull market, silver typically leads, followed by mining equities, and finally gold itself. That pattern is now fully intact. Markets are no longer moving on speculation alone. They're responding to real demand, improving margins, and growing confidence that elevated metal prices are sustainable.
But now that people are buying those stocks, it's because they're starting to realize that these high gold prices are here to stay, that gold's not going to come crashing down. And so these high earnings are going to continue. And in fact, at some point, people are going to recognize that not only are high gold prices here to stay, but they're going to get even higher, that the market's going to keep rising, which means earnings are going to keep rising. And so now stock investors want to get ahead of that. So now we have a more traditional bull market where the stocks are leading the metal anticipating the increase because stocks are forward-looking, right? Stock investors are trying to predict the future when they buy stocks because they're making a bet on what those earnings are going to be. And when you have a nice bull market where investors expect the bull market to continue, you would expect them to pay up for the gold and silver stocks. That's what they're doing. Now, those stocks are still cheap, but at least they're leading the way. And I've always said that in a real gold bull market, silver outperforms. And up until this year, it was underperforming. That's why earlier in the year, you could buy 100 ounces of silver for 1 ounce of gold. Now, I didn't check the ratio, but I think it's around maybe 67 or something. It's below 70 to 1. Still cheap. Silver is still cheap, but it's not nearly as cheap as it was. And remember, when silver got through 50, what was I saying on this market wrap? That was it. That now we have the double top is now support. 50 is the floor. And yes, I said we could go a little bit below it, and we did. We traded a little bit below it, but all of that was buying opportunity. And now we shot up, and now it's likely that silver's not going back to 50 again. It's not impossible, but it's very improbable at this point. In fact, I still believe that silver is going to hit $100 next year. And gold, at least 5,000, probably 6,000, maybe more, depending on what happens in the foreign exchange markets. If we get a dollar crisis, if we get a U.S. Treasury crisis, we're going to get those crises eventually, so it could happen next year. And if it does, then those upside projections are going to be much higher. But I do think that as the world really gets to think about what happened here with the Federal Reserve and their new policy, you're going to see big buying in Asia in both gold and silver and platinum. By the way, the whole precious metals complex is going higher.
Mining equities are forward-looking instruments. Investors buy them not for today's prices, but for tomorrow's earnings. The recent surge in mining stocks reflects a powerful realization. High gold and silver prices are not temporary distortions. They are becoming structural. For years, investors avoided miners out of fear that metal prices would collapse before profits materialized. That fear is fading. As margins expand and balance sheets strengthen, capital is finally flowing back into the sector. While mining stocks remain historically undervalued, they are now leading the metals, classic behavior in a mature and accelerating bull market.
It's an interesting situation. Silver has been suppressed by China in terms of price for years. The Silver Institute reckons that it's been in supply deficit for the last 5 or 6 years. And the only thing that makes up the difference is something called investment. So you've got investors, if you like, supplying the silver. Now, within that investment total, I don't think there's an awful lot in terms of genuine investment, but what there is stockpiles. And this particularly includes China. And what China has been doing is that when there is industrial demand around the world, it has been prepared to act as the swing factor to keep the prices suppressed. And that way, of course, the silver institutes, the calculations then run into balance. China has stopped doing that. I think there are a combination of factors as to, behind it. I think, first of all, President Trump's wonderful tariffs and his attack on China has woken China up to the fact that, you can't deal with this guy. And, the whole of the rare earth thing, which they've got control over, that's the one thing they've got, they've got the West, if you like, in their grasp there. And I think the other thing, as far as China is concerned, is that they can see that demand for silver is now going off the charts, and they're not willing to supply it anymore. The reason it's going off the charts is because India is becoming a major force in terms of silver demand. The Indian economy, I reckon, is roughly where China was about 25, 30 years ago. It is dynamic. It is expanding very rapidly in terms of its productive capacity. And because it has been opening, sort of coal-fired energy stations in big numbers.
Silver's rally is not being driven by Western speculation. In fact, futures market participation remains subdued. Instead, the surge is rooted in industrial scarcity. Global silver supply has been in deficit for several consecutive years, with stockpiles quietly bridging the gap. China has long acted as a stabilizing force, releasing metal to suppress prices. That era appears to be ending. With new export licensing restrictions and surging domestic demand, China is prioritizing its own supply security. Meanwhile, lease rates in London have climbed sharply, an unmistakable signal that physical silver is becoming increasingly difficult to source.
It's sort of trying to go carbon neutral by 2035, and the way it's doing that is that the government is subsidizing and encouraging major conglomerates in India to manufacture photovoltaic cells. So you have the situation where Reliance Industries, for example, is producing the most enormous quantity of photovoltaic cells. They're generating electricity out of these things, and they are demanding huge quantities of silver. And where do they go for it? Well, they have to go into the market. So you can see that you've got this squeeze happening. It so happens that China is now in the position where for years 26 and 27, she is introducing a new export licensing regime with the explicit purpose of protecting China's own domestic supplies of silver. So this shortage is now showing up in the markets big time. I saw one of a fellow substacker who is very, very close to the LBMA, has got all the figures and all the rest of it to a greater extent than I have. Tweeted this morning, or set a Substack out this morning to the effect that the lease rate in London is back up at 6-7%. The shortage is still there. So what we're seeing is an industry-driven re-rating. And the fascinating thing is that speculator interest or investor interest in the West is minimal. I mean, what's been happening on COMEX is that their open interest in silver has generally been declining. Now, I think there is a bit more, if you like, public interest in silver in Asia, because the Asians, I think, have a greater feeling that silver is a monetary metal and therefore is better than fiat currency. But this hasn't started here yet. And I can see that, with the price soaring today, I mean, as we talk, we're just under $64. People are going to be sitting there on their hands thinking, my goodness, we're missing out on this. What do we do? And, they'll probably try and pile in a market where there is no silver. And it's leading, in my view, to the destruction of the paper silver market. I mean, this is basically what we're seeing, I think, with open interest declining. The shorts don't want to be short anymore. And if the shorts aren't going to be short, then, the quantity declines. And that's really what we're seeing. And as to where it stops, I mean, the squeezes in commodities, are a lot more vicious than any squeeze you see in an investment category like stocks or, currencies or bonds or whatever. I mean, you do occasionally get a real sort of squeeze in an individual stock. But in commodities, I mean, this can take a commodity up 3 or 4 times over the period of a quarter or two. And I think we're seeing something like that happening in silver.
India is emerging as a decisive force in the silver market. Its economic trajectory mirrors China's expansion decades earlier, but with a unique energy transformation underway. Massive investment in solar infrastructure has triggered extraordinary demand for silver-intensive photovoltaic technology. Government-backed industrial expansion has turned silver into a strategic input rather than a discretionary commodity. Notably, rising prices have failed to unlock scrap supply, particularly in India, where holders appear reluctant to sell. This behavior signals deep confidence in silver's monetary and industrial value. When industrial users and households both refuse to part with supply, price pressure intensifies dramatically.
Well, the tends, you get a tendency for everybody to be the same way. I mean, in stocks, that doesn't really happen. You've always got sellers in a rising market in stocks, so that there is liquidity, if you like. So what you get is that when the price rises, it just creates liquidity, which, of course, is the standard textbook relationship between supply and demand is reflected in the price. But in commodities, it's very, very different, because when a commodity really starts moving, all the industrial users tend to be in the same in the same situation, and the supply is relatively inflexible. I mean, you've got mine supply, and that's more or less it. You might have some scrap supply. Now, this is interesting, because in India, scrap supply, you'd think that on a rising price like this, there would be scrap supply, but no, there isn't. Why? Because the Indian population collectively appear to be taking the view that they'd rather hang on to their scrap silver than sell it for rupees. I think you needn't look any further. I think the other thing is that when you get all commodities tending to move in the same direction, we talk about base metals a bit, which is what's happening. That tends to reflect a debasement of the currency in which you're measuring these things. So that is another factor which is behind this. It is certainly behind gold. Silver has this sort of industrial demand factor in addition. But if you look at the price of base metals, a basket of base metals priced in gold, very recently it's been at the lowest level ever, something like less than 20%. I think something like got down to about 17% of the 1900, like 125 years ago, value. And this has been, this sell-off has been really over the last 10 years or so. I mean, it really has absolutely collapsed in terms of gold.
The broader metals rally reflects more than supply shortages. It signals currency erosion. When commodities rise together, it often reveals declining purchasing power in the currency used to price them. Gold, historically stable money, exposes this distortion. Base metals priced in gold are near multi-century lows, suggesting profound mispricing. As emerging economies industrialize and Western currencies weaken under debt and monetary strain, these distortions will unwind violently. Inflation, not growth, is likely to dominate the next economic phase. Precious metals are not merely rising, they are repricing reality, and silver, with its dual role, may be the most explosive expression of that shift.
Now, the obvious story there is that, well, it reflects the gold price rising. The second thing is, who cares about pricing these things in gold? But that shows an ignorance of really what gold is. Gold is stable money. It is money without counterparty risk. It is money which credit used to refer to. And now that credit isn't referring to gold, it is credit that is declining. And it's messing up quite a lot of relationships on the way. Now, if you accept that gold, and history will prove this, that gold has relatively constant purchasing power over periods of time, then to see the value of a basket of base metals at under 20% of where they were in 1900, and for a long time while there was a gold standard, then you will understand that that basket of base metals is going to rise. I'm not saying when, but now seems quite likely. It is going to rise, measured in gold, by a factor maybe of 4 or 5 times in order to get back to that normal level. And if at the same time the purchasing power of dollars, euros, whatever, declines, then you can see that there is a massive bull market potential measured in depreciating dollars for a basket of base metals. And indeed, we're seeing copper has, been moving up quite happily. Now, here's the West on the basis that, it's looking like the economies are stagnating and so on. If you look at the Fed's beige book, you certainly get this view. If you go around the country, you'll see that it's actually very, very tough for the medium and smaller businesses, all that sort of stuff. So you would think that there wouldn't be the demand for these metals. So why should they be rising? Well, there's a twofold answer to that. That is, the obvious one is that the purchasing power of the currency you're measuring it is going down. And the second thing is that there's a whole world there being run by China and to a lesser extent Russia, which takes in about 70% of the world's population, which is rapidly industrializing and will generate huge demand, such as we haven't seen in the West, for these base metals. That's why China is hanging on to her silver, for goodness sake. And her rare earths, and even things like antimony, which is also part of this new licensing regime. So we're going to see these base metals rising in price, and this is going to be the big, big surprise, I think, in 2026. And not only that, but the declining purchasing power of the dollar means that consumer prices will also be rising quite sharply on their own volition. Inflation is going to be the big story. Forget what the Fed says. Inflation is going to be the big, big killer in 26 and into 27.